If you are close to retirement or already in it, there are probably a number of big money fears that tend to gnaw at you. And one of the ones that seems to top the list for retirees is this question: what happens if the market crashes right after I retire? That fear has a name: sequence of returns, risk. It's the idea that when the market falls matters just as much as how much the market falls. Let's say the market falls 30% and you're 7 years out from retirement. And that's kind of difficult, but you can probably deal with it. Let's say instead that the market falls 30% and you're 2 years into retirement and you're in a situation where you need to keep taking withdrawals from your portfolio. Well, if the market falls enough and you are forced to keep drawing from your portfolio, this could put your portfolio in a dangerous position. This could put you at risk of running out of money down the road. On the other hand, if you retire into a really strong market, and let's say you don't run into a large market downturn until you're, say, 20 years into retirement, and that's when you experience a 30% market decline, well, at that point, it's probably not going to affect your retirement much at all. So timing matters. Extreme losses early on can be painful depending on your circumstances. Hey guys, I'm Jack. What's up? And welcome back to the channel. Before we dive in, hit subscribe and turn on notifications so you never miss our latest videos. Once you start selling shares in a falling market to cover living expenses, you're locking in those losses. You are reducing the number of shares available to participate in the eventual recovery. And if the decline is deep enough and long enough, it may damage your portfolio in a way that you may never fully be able to recover from. So that's a legitimate concern and we're not going to dismiss it. But today we're going to use the data to show you why, for most retirees, assuming you go into retirement prepared, this risk is far more manageable than it may first appear. Let's start with the raw historical data. Here's every major U.S. stock market bear market going back to 1929, along with two important numbers: peak-to-peak recovery, how long it took from the prior market high to reach a new market high, and bottom to recovery, how long it took from the market bottom to recover back to the prior peak. Both columns matter, so showing only one of them would give an incomplete picture. Take a moment to look at these numbers. Some recoveries were fast: the 1980s crash, the brief 2020 COVID drop, and the 1966 decline. Markets bounced back in months. Others were genuinely brutal. The dot-com crash and the 2008 financial crisis took years to fully recover on a peak-to-peak basis. And then there's 1929, the Great Depression, which took over 25 years to recover from peak to a new market high. That is not a number we can gloss over. It's real, it happened, and it serves as a reminder that catastrophic events are possible. Yes, some full recoveries took many years, but once markets finally bottomed, recovery often happened faster than retirees emotionally expected. And here's where I want to give a quick nod to having cash reserves and a diversified portfolio, because it's in these moments during tough market conditions that you'll realize having cash reserves and a diversified portfolio gives you the breathing room needed to allow for recovery. But we'll get back to that. When we look at this table, it tells us something very important. A lot of people who look at this table of stock market bear markets think it tells the story of a typical retirement portfolio, but it doesn't, not even close. Here's the part that people don't talk about enough. When we're looking at this data, retirees are almost never 100% invested in stocks. If you're going into retirement or you're already there, you're likely holding a portfolio that includes stocks, bonds, and cash, and you likely have other income sources as well. This level of diversification doesn't completely eliminate risk, but it does help you manage it better, and it turns the math in your favor more often. Let's look at a reasonable retiree portfolio. Let's say we have 60% stocks, 30% bonds, and 10% cash or cash-like equivalents. Now let's see how those same bear markets played out for a hypothetical retiree with this type of portfolio. That table certainly reads differently than the first. The losses are smaller and the recovery times are shorter. Most of the events that felt catastrophic when they originally happened look much more survivable through the lens of a diversified portfolio. The 2008 financial crisis dropped this portfolio by roughly 16%, not 57%. The dot-com crash resulted in about a 13% decline, not 49%. The brutal 1973 to 74 bear market saw roughly a 20% loss for this portfolio, compared with 48% for a portfolio invested entirely in equities. And look at the recovery times. Here we're talking about 3 or 6 months, or maybe even 1, 2, or potentially 3 years. In the previous table, however, it wasn't uncommon to see recoveries take 5, 6, or even 7 years in total. So this fundamentally changes the experience of retirement. Having a diversified portfolio makes a difference. Now, there's one important caveat. You will notice 2022 on that list. That year was unusual because stocks and bonds both fell at the same time, something that has historically been much rarer. In that case, diversification didn't work as effectively as it usually does, and it's worth acknowledging that. Balanced portfolios do not always work perfectly, but throughout history, they have tended to reduce the impact of market downturns. Let's bring this to life with an example. Imagine 2 retirees entering 2008. Both have a $1 million portfolio. Both retired just before the onset of the financial crisis, but their experiences end up being quite different. The first retiree is 100% invested in stocks, as this information is often presented, even though that's an unlikely portfolio for a retiree. They're fully dependent on portfolio withdrawals, and they have very little cash set aside. During the financial crisis, the stock market ultimately fell nearly 57%. That retiree watched their $1 million portfolio temporarily collapse to roughly $430,000. Historically, it took the market about 5.5 years to fully recover to its prior peak, and about 4 years to recover from the market bottom itself. Every withdrawal during that period likely felt terrifying, having to sell shares while the market was collapsing just to pay the bills in retirement. The second retiree also experiences losses, but they entered retirement differently. They hold a diversified portfolio, 60% stocks, 30% bonds, and 10% cash equivalents. During that same crisis, instead of falling nearly 57%, their portfolio may have declined by closer to 16%. Their $1 million portfolio temporarily falls to around $840,000 instead of $430,000. Historically, a portfolio like that likely recovered in roughly 2 to 3 years from peak to recovery, and perhaps 1.5 to 2 years from the market bottom itself. They also have meaningful cash reserves. They have Social Security coming in to help cover their baseline expenses. They have flexibility built in, so they can reduce their withdrawals from their portfolio should they fall on hard times, and that flexibility proves invaluable. Of course, neither retiree enjoys the bear market, but one feels emotionally trapped because they're forced to continue drawing from their portfolio while it's taken a severe beating. The other feels like they have more options, they experience a smaller decline, and they have flexibility with their spending, which can give them a greater sense of peace. Here is a simple but powerful piece of math that explains why reducing your portfolio loss is so important. If the S&P 500 fell 50% and you were 100% invested in stocks, you would need a 100% gain just to get back to where you started. That could take years. But if your diversified portfolio only fell 10% during that same event, which is exactly what the data above suggests is possible, you would only need an 11% recovery. That might happen within months. What should matter most to you is not how the stock market is performing, but rather how your portfolio is performing, and those can be 2 very different numbers. This is exactly why obsessing over the S&P 500's daily movements can really affect retirees psychologically. Once you're in retirement, it's very unlikely that the index represents your entire portfolio. Instead, it's much more likely that you have a diversified portfolio. You may have some S&P 500 exposure, some other equities, and perhaps some bonds. Maybe you have cash. Maybe you have Social Security coming in, and this changes your personal financial picture. If the market does take a serious fall early in your retirement, what are your actual options? Well, there are 4, and understanding all of them can change how you think about the problem. Option number 1, continue withdrawing proportionately. This is the classic total return approach. You simply keep drawing from your portfolio in the same proportions, regardless of what the market is doing. This is mathematically efficient, and it maintains your asset allocation discipline, but it can be psychologically brutal because you're selling shares while they're taking a beating. Truth be told, most retirees do not follow this approach because it isn't human nature to behave like a robot. When you see your portfolio taking a beating, it's only natural for most people to tighten their belts and cut back on their spending a little. On the other hand, when they see their portfolio performing exceptionally well, they tend to give themselves permission to spend a little more and enjoy themselves. That's simply human nature.
Option number two, spend from a dedicated cash reserve.
If you've set aside, say, 1 to 2 years of living expenses in a dedicated cash reserve, perhaps in a high-yield savings account, you can draw from it when the portion of your portfolio invested in the market is taking a beating. This can give you valuable breathing room. Now, it doesn't eliminate the problem because a prolonged market decline could completely exhaust your cash reserves, but it does help because it can reduce the number of shares you have to sell at depressed prices. When that distinction matters more than most people realize. Here's the key insight. Markets often recover before a retiree fully exhausts that cash reserve. So this is the real argument for having one. It's not that you never touch your equities, but rather that it helps reduce the number of shares you have to sell at depressed prices or during the worst possible moments. And when you look back at the recovery data we just walked through, this point really comes to life. For retirees who enter retirement with a diversified portfolio, most historical recoveries have occurred within roughly 6 months, 1 year, or perhaps 2 years. That means a well-funded cash reserve covering 1 to 2 years of living expenses has historically provided enough breathing room to help retirees get through the storm without making permanently damaging decisions. The market's recovered, the portfolio's healed, and for those retirees who avoided panic selling during that time, they were in a prime position to take advantage of the recovery when it happened.
Option number three, temporarily reduce spending.
This option is massively underappreciated, and many retirees naturally do it during a market downturn. Maybe they skip travel, maybe they postpone home upgrades, maybe they simply cut back their spending a little. Perhaps they give a little less to family and friends. Even modest spending flexibility can dramatically improve a portfolio's sustainability over time. Let's say you're willing to reduce your portfolio withdrawals by 10% to 15%. That small adjustment can significantly improve the math, helping your portfolio last longer. And keep in mind, when you're reducing your withdrawals, you likely still have other sources of income. Maybe you're receiving Social Security, maybe you have a pension, or perhaps you still have income from work. Option number 4, lean on guaranteed income sources. This is where Social Security, pensions, annuities, and part-time income become psychologically and mathematically powerful. A retiree who's able to cover the vast majority of their necessary expenses through more reliable income streams simply is not as dependent on their portfolio. They have the ability to dial back their withdrawals if their portfolio needs it. This gives them greater flexibility. If there is one thing to take away from everything we've just covered, it's this. A cash bucket is a tool, and it's a useful one, but it's not the hero of the story. The retiree who handles a bear market best is not necessarily the one who has exactly 3 years of cash reserves. It's the one who's built flexibility into their plan from multiple different directions. The retirees who do best tend to have multiple income sources, not just their portfolio. Flexible spending, the ability to pull back temporarily without panic. Emotional discipline, the willingness to stay the course. Some cash reserves to reduce forced selling at the worst possible moments. And a diversified portfolio so the losses themselves are smaller. That combination is far more powerful than any single tactic. If we experience another 1973 to 1974 situation, perhaps another dot-com crash, or a prolonged Japan-style scenario, a cash bucket alone would likely not be enough. But a retiree who has Social Security coming in and covering a strong portion of their baseline expenses, a retiree with a diversified portfolio across bonds and equities, and a retiree with robust cash reserves, maybe that's 1, 2, or 3 years worth, is in a strong position. They may not be invincible, but they're in a much stronger position. Bear markets are real. Sequence of returns, risk is real too. We're not here to pretend otherwise. But the narrative that a stock market crash will inevitably devastate a retiree's portfolio is usually built on the flawed assumption that a retiree is 100% invested in equities, has no other income sources, has no cash reserves, and has no flexibility with their spending. That's usually not the case. Most retirees are not that person. When you hold a diversified portfolio, when you have income from Social Security or other sources, when you have some cash set aside to create breathing room, and when you're willing to make modest adjustments during rough stretches, you are not experiencing the same bear market that the headlines are screaming about. You generally experience a milder version of it, with smaller losses and shorter recovery times, and that matters. Retirees do not experience bear markets the same way the S&P 500 does if they're not 100% invested in the S&P 500. And understanding that matters. It matters that you understand your own personal situation and your portfolio. So protect your household, build diversification, build in flexibility, build other income sources, and yes, keep cash reserves at the ready, because when the market eventually pulls back, and yes, it will eventually pull back because that's what the market tends to do, you want to put yourself in a position where you're not forced to make a catastrophic decision because of it. So what are your thoughts on portfolio diversification and how it can help mitigate your losses? I'd love to hear. Leave a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing. And if you know someone who might benefit from this type of content, please consider sharing it. I'll see you soon. Bye